Welcome. In this video, when will a ZBCN coin bearish wave be complete? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
The Elliott wave theory is a well-established and detailed analytical approach that argues price movements in markets develop within a specific rhythm and structure. According to this theory, the prices of financial assets move in certain formations based on the cyclical nature of investor psychology. The most basic version of these structures includes a 5-wave upward impulse formation followed by a 3-wave corrective structure. In this context, the current analysis suggests that the market has completed a 5-wave upward structure and is now entering the classical correction phase, meaning the ABC correction has begun. The 5-wave impulse structure is the cornerstone of a trend in Elliott theory and is classified as follows. Wave 1 is typically the first sign of a new move. Wave 2 is a correction but does not break the previous low. Wave 3 is usually the longest and strongest wave. Wave 4 tends to be more sideways and complex. And Wave 5 is the final phase of the rise, often representing a period of weakening momentum and profit-taking. Upon completion of this structure, the market direction temporarily changes and a correction begins, usually taking the form of an ABC structure. In the current price structure under review, the 5-wave upward impulse appears to have been clearly completed. This completion is supported by several technical signals that indicate the trend has technically reached its end, the market has entered the overbought zone, and a correction is now needed. Notably, the decline in volume in Wave 5, the loss of momentum, negative divergence in the RSI, and weakening in the MACD all suggest that this impulse wave has come to an end. With the completion of this 5-wave structure, the market has naturally entered the corrective phase. This correction, in line with the classical rules of the theory, consists of A, B, C waves. Our current analysis shows that the first leg of this correction, Wave A, has been completed, meaning the price has given its first strong downward reaction, and the market is now entering a recovery phase in response to this decline, known as Wave B. Wave A is often not perceived as a correction by the market. Many investors think of it as a temporary pullback. However, Wave A actually signals the end of the upward trend and the beginning of a new corrective cycle. The nature of Wave A is usually fast and directional, as profit-taking and technical correction expectations come into play from investors who open positions during the prior uptrend. This wave is typically formed with strong volume and sharp price action. The current technical structure shows us that Wave A has been completed, and following this sharp decline, the market is now turning upward again into what appears to be Wave B. In this scenario, it is expected that in the near term, the price may gain upward momentum again, but this momentum is likely to be limited, and a new lower level will potentially be tested with Wave C afterward. At this point, strategic investors should view Wave B as a wait-and-see zone. Positions taken during Wave B may be short-term. However, for medium to long-term positions, the real focus should be on following Wave C, which begins where Wave B ends. This is because Wave C is often the most clear and directional corrective movement. Wave A causes fear, Wave B brings hope, but Wave C reveals the truth. Elliott analysis at this stage is not just a technical reading, but also a kind of map of market psychology. Throughout the 5-wave upward movement, the market is dominated by hope, confidence, enthusiasm, and even greed. But with Wave A, panic takes over. In Wave B, hope returns. That hope is shattered with Wave C, and the market begins a new search for balance. In our current scenario, we are entering the stage of hope, Wave B. During this period, news flow, social media sentiment, and investor behavior must be closely monitored. Every investor participating at this stage faces the risk of being on the wrong side of a potential Wave C decline. In conclusion, a classic Elliott structure is being observed in the market. The 5-wave impulse move has been completed, followed by a sharp Wave A correction, and now the market appears to be preparing for an upward reaction in the form of Wave B. This phase is temporary, counter-trend, but deceptive. The real corrective move is not yet over. Therefore, investors should view this period not as an opportunity hunting phase, but as a time for risk control and confirmation seeking. But we can't base our analysis on Elliott wave theory alone. Let's take a look at other metrics as well. Stay tuned.
For investors trying to understand the rhythmic structures underlying market movements, the Fibonacci analysis method stands out as one of the most time-tested and reliable tools. Fibonacci ratios are not only foundational in technical analysis, but are also found in many structures in nature. In financial markets, these ratios are particularly used to identify potential reversal levels in retracement zones. The most well-known and frequently used of these are the 0.618 and 0.786 levels. These levels are considered critical by both technical traders and algorithmic systems, and are often areas where price reacts strongly. When analyzing the current technical structure, it's clear that the price has made a strong upward move from a certain low point and has since entered a natural retracement phase. Applying Fibonacci retracement levels from the low to the high, the price appears to be pulling back into the zone between the 61.8% and 78.6% levels. This zone is viewed in technical analysis not just as a retracement area, but also as a potential liquidity pocket, a reaction and reversal zone. The 0.618 level is also known as the golden ratio. This ratio appears in numerous symmetrical and perfect formations in nature, from spiral seashells to the structure of galaxies. In markets, it's observed that collective investor psychology often adheres closely to these levels. Especially during corrections within trends, it is common to see the price react at this level. Many technical traders view this level as a completion point and build strategies to open long positions from here. In fact, some algorithmic trading systems automatically trigger long positions once price enters this zone. The 0.786 level represents deeper retracements. This level is generally less well known, but requires more patience and confidence. Price reaching this area often scares investors. A move that has retraced significantly from the peak often gives the false impression that the trend is over. However, for traders who adhere to the principles of Fibonacci, the 0.786 level signals that the trend may still be alive, is just testing the final buyers and providing strong hands with an opportunity to re-enter the market. The price movement between the 0.618 and 0.786 levels forms what's often referred to as the golden pocket. This is one of the most favored areas for large players seeking liquidity. Stop losses are triggered here, weak hands lose their positions, volume drops, and the price temporarily appears lifeless. However, behind this calm lies a buildup of energy. When the price reverses upward from this area, it can explode like a spring, leading to a strong rally. If the price breaks below the 0.618 level, the next level to watch is the 0.786 level. This point is where many investors give up on their positions, but patient and strategic traders look for opportunities. Reversals from this level are often sharp and sudden as the price has reached the turn here or the trend dies point. Taking positions in this area requires courage and discipline. Historical examples show that entries from this zone often offer high reward to risk ratios. At these turning points, Elliott wave structures can also be observed. For example, if the price has reached this zone through an ABC correction and the C waves is completed in a five-way structure, then the reversal is strongly supported from a wave theory perspective. Similarly, harmonic formations, especially the Gartley, bat, or butterfly, tend to complete in this area, increasing the probability of a reversal. In this context, it's fair to say that the price has entered a decision-making phase between the 0.618 and 0.786 levels, and the reaction formations that develop here will be highly influential in determining direction. Upward breakouts from these levels are typically strong because many technical traders increase their positions after confirming the reversal, some initiate new entries, algorithms activate, and the rally strengthens in a chain reaction. From a market psychology standpoint, these levels are also important thresholds. A move to the 0.618 level is generally perceived by investors as a reasonable correction. However, when the price reaches 0.786, many investors begin to panic. This results in emotional traders being filtered out, while disciplined traders rise to prominence. These levels, therefore, are not only technical zones, but also psychological tests. In conclusion, during the retracement phase following the move from the bottom to the top, there is a high probability that the price will reverse within the 0.618 to 0.786 Fibonacci retracement zone. Buying from these levels can lead not only to short-term rebounds, but also potentially lay the foundation for a new trend. Investors should approach these areas not with haste, but with patience and a confirmation-seeking mindset, as this is the smartest way to minimize risk while maximizing potential return.
For investors who apply technical analysis in the markets, the MACD is one of the most commonly used oscillators, particularly valued for its ability to detect trend reversals in advance. The data provided by this indicator reveals the direction, strength, and potential for change in the momentum behind price movements, which is why many investors place significant weight on MACD signals in their decision-making processes. Looking at the current chart analysis, it can be observed that the MACD line and the signal line are converging, with a potential upward crossover likely to occur very soon. This potential crossover increases the probability of a change in price direction and draws investor attention to this point. When examining the structural features of the MACD line, calculated as the difference between two exponential moving averages, and the signal line, its short-term average, establish a link between short-term momentum and the longer-term trend. In this context, when the MACD line is about to cross above the signal line, it means that short-term momentum is strengthening and beginning to exert pressure on the long-term trend. Therefore, if such a crossover occurs, it's highly likely that the price will be in upward momentum. This crossover typically emerges during periods when the price is consolidating in a bottom region or entering a sideways stabilization phase after sharp declines. Structures in which the market first slows down and then breaks out of this flat range due to renewed momentum make the MACD signals even more valuable. In areas where such crossovers are likely to happen, investors are often hesitant. That's because the price has not yet shown a clear upward trend, and the effects of the previous downtrend often linger in traders' minds. However, this upward MACD crossover is a strong signal that underlying market dynamics are beginning to rebuild and that the market is regaining strength. This signal becomes even more compelling when it's accompanied by shrinking negative histogram bars, eventually turning positive. A slowdown in the histogram's negative direction, followed by a move above the zero line, is a clear indication of a shift in momentum. An upward crossover in the MACD is not just a technical event, but also the crossing of a psychological threshold. The emergence of this signal marks a shift in market sentiment. Investors who have been under bearish pressure for an extended period start to feel hopeful again with the MACD crossover. Traders who have been hesitant to open long positions now view this crossover as confirmation and are inclined to enter the market. This puts upward pressure on price and often sets the stage for a volume-supported rally. Moreover, such MACD crossovers generally yield more reliable results when evaluated in conjunction with the price chart, especially when the price is forming a bottom at a key support zone. That's because relying on a combination of signals from multiple technical components, not just a single indicator, enhances the accuracy of trading strategies. Therefore, if this crossover occurs, it would be wise for investors to also pay attention to chart formations, volume levels, and other oscillators, not just the MACD. An upward crossover in the MACD indicator is often a sign that the price is about to gain momentum following a correction. What matters at this point is whether the MACD line continues to move above the signal line after the crossover. If the MACD line moves upward at an angle and the histogram bars are growing, it indicates not only a change in momentum direction, but also an acceleration in momentum. This suggests a more decisive price increase. On the other hand, it's important to understand that even if a MACD crossover occurs, the price may not immediately begin to rise. In some cases, such signals may work with a delay. Therefore, investors should not only consider the moment of the crossover, but also the confirmation signals that follow. For example, whether the price can break through short-term resistance levels, whether volume is increasing in the upward direction, and how overall market sentiment is shaping are all crucial at this stage. The MACD crossover can serve as a standalone signal, but its effectiveness increases significantly when combined with broader market context and other technical tools. This crossover often signals the birth of a new trend in the market, especially when the MACD line, which had been consistently suppressed during the previous downtrend, finally crosses above the signal line. It indicates that sellers are weakening and buyers are beginning to take control. Such shifts often signal that the structure of the market is changing. In other words, the downtrend has ended and an upward trend has begun. This can create strategic opportunities for both short and medium-term investment decisions. The MACD crossover also transforms the trading psychology of market participants. Investors who have long witnessed downward market movement start to regain confidence after the signal. This confidence increases the appetite to open positions and often helps the price break through previously unbreachable resistance levels. In short, the MACD upward crossover becomes not only a technical indicator, but also a trigger for psychological transformation in the market. In conclusion, this potential upward crossover observed in the MACD indicator is a highly valuable signal in terms of technical analysis. This process, where price is poised to gain momentum, momentum is shifting direction, and market psychology is preparing for an upward shift, is a transitional phase that investors should closely monitor. The occurrence of this crossover may indicate that not only could price rise, but also that a new phase in the market may be beginning. Therefore, giving this signal the attention it deserves could be very beneficial for strategic positioning. The MACD crossover is just about to happen.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.